Well, we kind of alluded to this at the beginning, but let's talk about contribution types, because this is going to be another big decision that anybody who starts their 401k, they're going to have to make a decision. They're going to say, hey, do I want to do pre-tax where I take the tax deduction now? That's considered traditional because that's when these things first came on the scene in the 80s. That's the only option you had. But then fast forward, there's also now what's considered a Roth option. And most plans do offer Roth options. That's where you put the money in. You don't get a tax deduction now, but you get tax-free growth into the future. That can be extremely powerful. How do you balance all these things, Bo?
Yeah, and then another thing about the Roth that's really unique when it comes to 401ks is if you're familiar with Roth IRAs, you know they actually have income limits. If you make over a certain amount of income, you cannot contribute to a Roth IRA. With Roth 401ks, that is not the case. Even if you make $1 million a year, you could still choose to put money into your Roth. So what you want to do is you want to look at your current tax situation and say, okay, do I think the tax rates are higher now and going to be lower in the future? Or do I think my tax rate is lower now and going to be higher in the future? And depending on how you answer that question will dictate, should I do pre-tax contributions or should I do Roth contributions? But for a small segment of the population, there is actually a third contribution type inside of your 401k, and it's called an after-tax 401k contribution.
Yeah. After tax allows the mega backdoor Roth,
right.
And that's got Bo, it's got some complications to it. It gets kind of sophisticated. What should people look for to know if they should do it or not?
Yeah, so what you want to make sure of is if I'm going to take advantage of after tax, I get to put money into the 401k, and these contributions are not capped at the $23,000 salary deferral. I can actually contribute to the after-tax bucket all the way up to the Section 415 limit, all the way up to $69,000 a year in this bucket. But I want to make sure if I'm doing that and I'm trying to take advantage of the mega backdoor Roth, that my employer either allows for in-service Roth conversions or in-service distributions where I can do the after-tax contribution and then push that money out to a Roth IRA. If I'm doing that, it allows me to maximize the amount of dollars I have going into Roth. So it's not uncommon for higher income individuals to max out the pre-tax salary deferral and then put the rest of the bucket availability they have into the after-tax contribution to do mega backdoor Roth. It's a way to supercharge your retirement savings.
So we just talked about the mega backdoor Roth IRA contribution, but there are other unique 401k provisions that we need to make everybody aware of. Bo, kick us off with self-directed brokerage accounts.
So if we've ever participated in a 401k, we know there's usually a list of investment options we can choose from. And there's somebody out there like our firm that will choose the investment options available inside the plan. And you might have access to 10 options or 20 or 30 options, but basically it's a love the one you're with. You're limited to the options that some investment committee has chosen to put in there. Well, with some 401k plans, they say, hey, if you don't just like the options that are available in the plan, you can open a self-directed brokerage account where we can actually open a brokerage account inside of your 401k where you have unrestricted access to the entire investment universe. Fidelity has a popular version of this called the brokerage link option, and Schwab has a popular version called the PCRA, the personal choice retirement account, where it's actually an option you select in the 401k where then you can invest in any number of mutual funds, ETFs, stocks, bonds that allows you to really customize your allocation and create some unique tax planning opportunities for folks who need to be able to take advantage of that benefit.
There are some unique things. Like if you look at your 401k and you go, man, where are all these index funds that I hear these guys talk about that are so beneficial? I don't see any index funds in my plan. This might be your ability to add that to your portfolio. The other thing is, well, what happens when you build enough success that you're like, I'd like to go beyond just stocks, bonds, and cash. I'd like to have real estate and other things in my portfolio. This is the type of thing that opens it up. I will tell you, pay attention to what are the limitations, though. Are there any restrictions? Because there will be costs. There could potentially be restrictions. Like we've even seen these self-directed to have limits on what percentage of the portfolio. The third opportunity that I think this also creates, maybe you reach the level of success and complication where you're like, yes, I'd like to add more diversification. I'd also like to get away from index target retirement funds because I'd like to start paying attention to tax location. This is an opportunity sometimes to work with a professional advisor because the advisor can have access to these self-directed accounts, even get download access and other things. It's a really slick opportunity.
So that's a unique provision to be aware of. Another one that you want to know about, but I hope that you never actually have to use, are 401k loans. In our opinion, you should avoid borrowing money from your 401k at all costs. It should be like a break glass in case of an emergency, last ditch thing that you reach into, but a lot of plans do allow for them, where basically you go into your 401k, you borrow money from yourself, and you pay that money back to yourself. Now, you may think that sounds great. I get to be my own bank and I'm paying my own self-interest. Where's the downside? Well, the downside is you're taking soldiers out of your army of dollar bills. So those dollars are no longer working for you into the future. And just because you're paying an interest rate doesn't mean that you're truly making that rate of return, because it's an amortizing loan over a fixed amount of time. So 401k loans, while they sound good in theory, they are actually incredibly costly when it comes to your long-term well-being. And by the way, if you have an outstanding 401k loan and you're laid off or you change jobs, you have to pay that loan back immediately, or it's going to be deemed to have been a taxable distribution to you, which is not something you want to have happen, especially if you're under age 59 and a half.
Another unique thing is if you're talking about access, because you just talked about 401k loans, there's also hardship withdrawals. Yep. And here's the thing, and these things are very noble in their purpose. Think about medical expenses, a disability, you owe money to the IRS. Isn't that ironic that the
They'll let you go in
IRS
for
tax
that.
code will let you go to pay a tax bill. And then even for provisions like for first-time home buyers, I will tell you, post-pandemic, one of the things as part of, a lot of the relief, the Secure Act and all those other things, is they created a lot of hardship access to retirement plans. I think there's going to be a concerning legacy that too many people broke that and went into it. Now, look, there's obviously it was a need for a lot of people, and I'm not getting on those people, but I would have challenged. I think a lot of people use this no different than when you change jobs. You see a lot of people that will go access those assets not for retirement, but to get out of debt or do something else. Be careful of these hardship withdrawals, because guys, we have a problem in America where people get to a retirement age and they just don't have assets for retirement. It's because we have too many leaky retirement accounts. So please heed our advice. Try not to use the loans. Try not to use these hardship provisions. That money is too important and needs to be saved for retirement.
Another unique 401k provision we want you to know about is the rule of 55. And what this states is that for most retirement accounts, most 401ks, most IRAs, you can't actually access those dollars penalty-free until you get past age 59 and a half. However, if you retire from your current employer in the year in which you turn 55, you can then access those 401k dollars without having to pay a penalty. So if they're Roth dollars, they'll be tax-free. If they're pre-tax dollars, they'll only be subject to ordinary income tax rates. For someone who is retiring early or someone who's thinking about checking out of the workforce in their 50s, this is a huge benefit, but you have to be employed in the year that you turn 55 in order to be able to take advantage of this provision.